Okay, we're gonna go ahead and get started. I just want to welcome everybody, and welcome to How to Invest in Multifamily Real Estate by Overland Capital. My name is Michael Holman, and I'll be your host today. We also have Ken Holman with us, and we'll introduce him shortly. So, Overland Capital is part of the Overland Group family, which is a fully integrated real estate organization that has been around for over 30 years now. I think we're actually coming up close to 35 years at this point. But the goal of Overland Capital is to provide investors with a better investing experience. And we believe a big part of that is giving people the opportunity to learn about investing in commercial real estate. We've all heard the phrase invest in what you know, and commercial real estate really is no different. So as we go through this presentation, feel free to ask questions throughout the presentation, and we will do our best to answer all questions at the end. Like I said, if you were here before, last webinar, I think we had so many questions we finally had to end it because we were getting too long. So we'll see if that happens here. For anyone who needs help locating the Q&A button, it is at the bottom of your screen. Also, you'll be emailed a copy of this presentation, but you can also view it on our website at overlandcapitalcorp.com and clicking on the education tab. A little bit about me. I run the investments and finance divisions of Overland Group. I spend a significant amount of my time working with equity partners and lenders. I'm also a licensed CPA. As I mentioned earlier, we have Ken Holman with us today. Ken is the president of Overland Group and has over 40 years of experience in commercial real estate. He has developed over $350 million worth of commercial real estate, and he also holds just about every top designation you can get in the real estate world.
Well, our topic today is how to invest in multifamily real estate. And we're going to start with first giving a little overview, and then on how to begin investing in apartments. And then we'll drill down on how to analyze multifamily investments. And finally, we're going to highlight some of the important keys to successfully investing in apartments. So let's begin by defining what multifamily real estate is. All apartments are considered multifamily housing, but not all multifamily housing is considered to be apartments. Multifamily housing is any housing project or property that has multiple separate housing units used for residential habitation. So they can be either owner-occupied or renter-occupied. Owner-occupied condominiums, for instance, are multifamily housing, but so are renter-occupied apartments. And so we're going to be drilling down primarily on renter-occupied apartments. We're not going to talk much about owner-occupied condominiums or other types of multifamily housing. Then another distinction is that although apartments are residential in nature, most experts consider any apartment project larger than 4 units to be commercial real estate. So we're going to be talking about a project and presenting basically a project that's larger than 4 units today. Gary Keller, the founder of Keller Williams Realty and author of the best-selling book, Millionaire Real Estate Investor, said in effect that real estate investing can be an awesome avenue to create financial wealth, which can absolutely change your life and your family's future. And I agree with that and truly believe that apartments are one of the best real estate investments available to most investors. Investors build wealth in real estate usually through 3 types of return on investment. The first type of return I'm going to talk about is cash flow. Cash flow is the money you have left over after paying all the operating expenses for the property and the debt service. The net cash flow is divided by the amount of capital you have invested, and that gives you the cash on cash return. So you can usually expect to achieve somewhere between a 5 to 10% cash on cash return. That's dependent on how high you leverage the property or how much debt you put in. I think I mentioned that the cash flow is the money that you have left over after paying all the operating expenses and for the property and the debt service. And you can expect to achieve somewhere between a 5 and 10% cash on cash return. That's dependent on how high you leverage the property. So I'll just go on from there. The second type of return is equity buildup. As you pay down your mortgage over time, a portion of each payment is applied to reduce the principal balance on the loan. That's just like every other mortgage out there. But even if the value of the asset stays the same, as the principal is reduced, your equity increases. Now, this is called return on equity and is often a significant portion of your return. The beauty, I think, of equity buildup is that your tenants provide the revenue to pay the mortgage payments while you get the benefit of the increase in equity. You can usually expect about 4 to 6% of your total return to be from equity buildup. Then the third type of return is appreciation in the value of the asset. Appreciation occurs because of several factors. First, due to inflation, the value of most assets go up over time. You don't have much control over that, but it's a positive in real estate. Second, if you're in a desirable location, the neighborhood itself may provide some additional appreciation in value, just because the higher demand for the neighborhood. And then third, demand in general, if it exceeds supply, it's likely you're going to see appreciation, regardless of the location that you're in. So this portion of your return, the appreciation, can often be less predictable, but it can become a really significant portion of your return on your investment. So the name of the game in apartment investing is passive income. The IRS identifies two types of income, active income and passive income. Everybody knows what active income is. It refers to the salaries, wages, and commissions that you can possibly earn, and all of which are taxed at ordinary income. Passive income, on the other hand, is income derived from rental property, and there are some specific rules how passive income is taxed. But the concept is that you earn income even when you are not actively involved in the activity. So apartments are absolutely one of the best ways to achieve passive income. Tenants provide the income to pay the operating expenses and the debt service, and then the government lets you depreciate the asset over 27 and a half years compared to other commercial properties, which are depreciated over 39 years. And you get to deduct that from the net income. So much of the income that you receive from apartments is really sheltered. The beauty of investing in real estate is that as your active income begins to diminish over time, your passive income can more than replace your active income. And we have several investors that are enjoying that at this time.
There are so many reasons to invest in apartments. First off, if you're in the right location, there's always demand for housing. One of the great things about apartments is they usually do good in good economic times and even have the possibility of doing better in bad economic times because more people are hesitant to buy houses. You can find apartments almost anywhere in the country. Next, there are a lot of management options available with apartments, so it can be as hands off as you'd like it to be. Financing is easier to get on apartments than most other asset classes. And lastly, there's great tax benefits to investing in apartments. So this is a pretty common question we get by new multifamily investors, and my answer is always the same. It depends on what your end goal is. I'm going to quickly outline some of the key differences between buying an existing building or building new. So for buying, some of the pros, there's immediate cash flow, there's no to little construction risk, there's no to little lease up risk. depending on the property. The cons really are that there's less return potential than building new. You also have the risk of buying a pig. I mean, you can put lipstick on a pig, but at the end of the day, you still have a pig. So you have to be careful with the property that you're
Hey,
buying.
hey, Mike. One of these days, I'm going to have to tell everybody my story. I actually, when I was in college, bought pigs. Literally bought pigs, and no kidding. I bought low and sold lower. It didn't turn out to be a very good investment for me, but we'll we'll have to talk about that another day.
Oh, that's hilarious. So that's what you don't want to do, everybody. Do not buy your apartments low and sell them lower. So we're gonna oh, that's hilarious. So we're gonna move on to building. So the pros and cons of building new is basically the exact opposite of what we just outlined. Your cash flow is more delayed and you have to deal with more risk, but your potential returns are usually significantly higher. Location is extremely important in a multifamily project. In general, you want your multifamily projects on or near major roads and highways. So we currently have 2 big apartment projects we're developing, and both are within a half-mile freeway exits. When evaluating cash flow, it's important to note that these are almost always presented as a projected cash flow. So pay special attention to assumptions. In general, operating expenses should usually be around 25 to 35% on large multifamily projects. Property condition and appreciation go hand in hand. You need to understand what the goal of your investment is. If you're trying to fix up your project, then a significant amount of your return is going to be on the value you create through your value add activities. If your investment is a pristine project, then most of your return is based solely in cash flow. Understanding the investment goals helps you understand how the project is anticipated to make money for you. Appreciation is sometimes overlooked when investing in apartments, but it is absolutely vital to understanding your return. Appreciation is the difference between the current market value of the property and the price you paid for the property. It's important to understand the relationship between different types of investments and appreciation as well. So I'm going to get into that a little bit here. Core investments, you're going to have just little appreciation. I mean, really, it's usually just appreciating with the market. A value add investment is going to have moderate to high appreciation, and development or new build investments, you're going to have a high appreciation. A very significant portion of the return is based on the appreciation when you're in a development investment. If you need a refresher on core value add and development, make sure you go to our website, overlandcapitalcorp.com, and watch our last webinar, The Beginner's Guide to Commercial Real Estate Investing. Ken's now going to go into some of the financial metrics that are important to multifamily investing.
Thanks, Mike. I think there are 7 key financial metrics used to analyze apartments, and I'll list them out here. Number 1 is capitalization rate, price per unit, price per square foot, price per rent per square foot, occupancy rate and its corollary vacancy rate, operating expense ratio, and operating expenses per unit. Now, what is the benefit of these 7 key financial metrics? We use these financial metrics to compare one potential apartment investment to another. And the metrics are not but they can be used to narrow down the number of properties. And let's take a look at each metric. This first one, capitalization rate, or cap rate as they call it, calculates the potential return assuming you're purchasing the property for all cash. So to get the cap rate, you divide the net operating income by the purchase price. The first thing you need to find out on any property that you're buying is the net operating income. So let's look at how that's calculated. Net operating, this is called the cash flow model that I've shown here, but the net operating income which is also known as NOI, is calculated by taking the gross scheduled income at 100% occupancy and deducting the vacancy or credit loss, and then adding any additional ancillary income like parking fees or forfeited security deposits, things like that. This equals effective gross income, or EGI, and from EGI you deduct the operating expenses to determine the NOI. The net operating income is then divided by the sale price or the list price or the value of the asset to determine the cap rate. Note that the cap rate does not take into consideration the annual debt service. So the reason for that is because every investor has a different ability to obtain a loan on the property that they're intending to purchase, and that's all based on their individual net worth and personal credit worthiness. Price per unit. This next metric is calculated by dividing the purchase price or list price by the total number of units. So say we're considering the purchase of a 120 unit apartment complex that's priced at $15 million. The price per unit would be $125,000. That's taking 15 million, dividing it by 120 to get that number. The third metric is price per square foot. I like this metric because it gives an accurate picture of what your cost is. You simply take the purchase price and divide it by the total square footage for the project. So if the unit size for each unit was 1,000 square feet and the total square footage would then be 120,000, plus you'd probably have some additional square footage for the clubhouse and any building common area, things like that. So say that would add another 10,000 in square feet. So your total square footage would be 130,000. Then you'd take your purchase price of 15 million, divide it by the 130,000 square feet to get a price per square foot of $115 per square foot. And you can compare that metric with every other property to kind of determine which one has the lowest price per square foot. Rent per square foot. I've seen this calculation handled a bunch of different ways. For most commercial buildings, excluding apartments, that's industrial and office buildings, the gross scheduled income is divided by total square footage to give an annual rent per square foot. Apartments, on the other hand, and other residential properties are unique in that they calculate the rent per square foot on a monthly basis, and that's how it's quoted. So that means that you'd have to take the annual rent per square foot by 12 to get a monthly square foot, and that would give you an accurate comparison compared to other apartment projects. Fortunately for most apartments, the rents are quoted on a monthly basis, so you don't have to do that division. But here's a little example of how that would work. If each unit rented for $1,200 a month and the unit size was 1,000 square feet, then the rent per square foot would be $1.20. And that's how you'd compare with others. Occupancy rate, let's that and its corollary vacancy rate. The occupancy rate is calculated by dividing the number of occupied units. Units were rented. Are we having an internet issue again, Mike?
It cut out a little bit, but just for a second. So you're good.
Okay. So the occupancy rate would be 100 divided by 120, or 83%. And the vacancy rate in this example would be 20 divided by 120, or 16.7%, or rounded to say 17%. The operating expense ratio divides the total operating expenses for the project by its effective gross income. And in our example, the gross scheduled income was $144,000 a month. And so that's 1,200 a month by 120 units. And the vacancy would be basically 24,000 a month. So your effective gross income would be 120 a month. If the operating expenses were 40 a month, the operating expense ratio would be 40,000 divided by 120,000 for 33%. And the last one that we're going to talk about is the operating expense per unit. That's where you take the total operating expenses for the project and you divide it by the total number of units. This is always calculated on an annual basis. So if the operating expenses in our example were 40,000 a month, that would mean there'd be 480,000 a year. You divide that by 120 and you'd come up with a operating expense per unit of 4,000 per unit. And I see that in apartments ranging anywhere from 3,000 on the really low side to as high as 5,000 or 6,000 on the high side. So in our example, this is kind of giving us an overall summary. If the effective gross income were 120,000 a month and the operating expenses were 40 a month, that would translate into an EGI of $1,440,000 a year. Assuming that you could get a loan at 75% loan to value, which is pretty common for apartments. It's a little less on other commercial buildings, but say it's 75%, then the loan you'd be able to get on a $15 million project would be $11,250,000. That means you'd be investing in cash $3,750,000 or 25%. So the monthly debt service on a loan of that amount would be about $60,000 a month, which would give you about $20,000 a month in cash flow or $240,000 a year. If you're going to calculate the cash on cash return, you would take that number, 240,000, divide it by your cash investment amount, in this example of 3,750,000, and that would be your cash on cash return, which would equal about 6.4% in this example. Now you basically have all the financial tools you need to analyze an apartment investment. I'm going to turn it over to Mike here for a minute to discuss some of the other things that you should consider.
Thanks, Ken. So we have all made mistakes in investing. So we're going to point out 4 of the biggest mistakes we see both new and seasoned investors make. Do not fall victim to these. So number 1, take everything your broker says with a grain of salt. Now, brokers are fantastic and we love working with them and recommend new investors find and work with a quality broker as well. That being said, understand that brokers make money by buying and selling property. They don't get paid if you walk away from a bad deal, but you better believe they get paid if you decide to pull the trigger on a bad deal. Know that going into the relationship. Underestimating the cost is a big problem, especially on new developments. Make sure you go with a reputable development and construction firm. Even seasoned developers are struggling with this right now, especially with rising construction costs. But new developers are especially susceptible to this. We actually just had a person developing his first apartment deal come ask for our help because he underestimated his cost by a long shot. He's begging us for help because he's in over his head at this point, and unfortunately, he asked for our help much too late after there was really anything that we could do for him. It's a hard situation. Don't get yourself into that. Once again, do your homework. Like I mentioned, a good rule of thumb for operating expenses is 25 to 35% of revenue on 100 plus unit multifamily projects. If someone shows you that you can make a 25% return but has operating expenses at 15% of revenue, you probably need to walk away from that deal. 4th is overlooking the property condition, and that is directly tied usually to being too emotional in the project. When new multifamily investors struggle to find a project to invest in, they sometimes become too emotionally attached on the first project that is kind of what they are looking for. What those emotions usually translate into is paying way too much for a dog of a property. So one of the important questions that you need to answer for yourself is, do you want to go in as part of a deal or go it alone? There are pros and cons to each of these situations, and it's important to evaluate your goals to figure out which arena you want to play in. So the advantages of going it alone, I mean, really you have the potential for all of the profits. Obviously less any fees that you have, but you get to keep all the profits. You get to make all the management decisions. Now, in some people's minds, that's a positive. In some people's minds, that might be a negative. That being said, we do not recommend going it alone unless you have extensive multifamily investing experience. Now, if you want to ignore what I just said and you're saying, I'm going to go it alone no matter what, let me just give you some advice. Make sure you surround yourself with lots of seasoned consultants. I mean, attorneys, developer, general contractor, management firm, etc., because that will really help save you a lot of heartache down the road. Now, on the flip side, most of us probably don't have $25 million to buy a 125 unit multifamily investment. But that's where syndications really shine. You get the benefits of a large project and can usually invest as little as 100,000. On some projects, you can even get down to 50,000. That's a much more manageable number than 25 million. So most syndicators are experienced real estate investors. Do your homework on the syndicator, but if they're good, that can take a lot of worry, stress, and commitment off your plate to focus on other things. As the projects get larger in size, so does the number of exit strategies. When you're building a 250 unit, $50 million multifamily project, you open the floodgate to a lot of high powered buyers, including REITs, insurance companies, and hedge funds. None of those players are looking at the 6-unit apartment your buddy convinced you to buy with him or her. I'm not going to go into detail about accredited investors, but just know that a lot of syndications do require you to be accredited in order to invest with them. So what you can do to find out more information on this, go to our website, overlandcapitalcorp.com. We have an article that's all about accredited investors, help you understand if you're accredited, if you're not, anything. Go there, help you answer all of your accredited investor questions. A good rule of thumb when it comes to exit strategies, always know what the intended exit strategy is going into the investment. And I'm placing a lot of emphasis on that, and what the backup to that primary exit strategy is. Investing in multifamily isn't like investing in stocks. You can't just go on your computer, click sell on your investment, and the cash comes into your bank account the next day. Exiting a $10 to $50 million project is a big deal, and a lot of factors come into play. So you need to understand how the syndicator or how you personally are going to exit this property. Let me turn it back over to Ken now.
So to wrap it up, I thought we'd present our 6 keys to successfully investing in apartments. And number 1, you need to understand the market. We usually obtain a feasibility study which identifies the supply and demand factors on each project. And this provides a third-party verification that we're making the right decision. Number 2, analyze each project using the 7 financial metrics. This allows you to name the properties that you're analyzing and select the one that you think is just right for you. Number 3, do your homework on the property that you've selected. That means not only looking at it from a financial perspective, but also understanding the conditions of the property and the direction in which the neighborhood is moving. It's all really vital that you understand and do your homework on each project. So, number 4, build relationships with experts. This can include brokers, managers, developers, syndicators, and anybody else who can really help you understand your apartment deal. Number 5, get your financial house in order. The better your credit and your credit worthiness, and the higher the net worth you have, the more likely you're going to be able to get good financing terms, which can make the difference between a good deal and a bad deal. Then finally, number 6, be persistent. You have to review dozens and dozens of properties before you find the one that makes the most sense to you to invest in. But I can tell you, if you follow these 6 keys to success, you'll be able to achieve dynamic returns, which will make it possible to replace your active income with passive income. Then you just get to go play and have some fun for the rest of your life. And that's all, folks. We really appreciate each of you, and thank you for joining us today.
So before you go, please make sure to take the poll that pops up on your screens, as this helps us to get to know you better. We're going to go ahead and get the Q&A started as well as you take that poll. So our first question comes from Reed. He asks, what are your thoughts on effects to future multifamily property valuations due to the current political trend to establish additional rent controls in some communities, particularly Long Beach / San Pedro, California?
So, Reed, I was a little concerned you were going to ask what impact bombing Iran may have, but I'm glad we didn't go there.
I'm glad we didn't go there. I'm glad we didn't. Yeah, we're not.
I'm glad we didn't even bring that up, right?
Yeah. Okay. So back to the task at hand.
On rent
controls.
Yeah. So let's talk a little bit about rent controls. California is one of the few markets that I've seen where rent controls really play a significant impact on the community, and they can have a very detrimental impact on what your returns are. Because if you remember in our cash flow model, the most important thing that you need to consider is net operating income. That determines your cap rate, that determines your overall value of your asset. Rent controls tend to lower your NOI. The lower the NOI, the lower the value of the asset. So we prefer to invest in areas where we aren't hamstrung with rent controls. But that being said, if your rents are high enough that those rent controls don't limit your ability to get the returns that you want, whether it's in California or anywhere, you're probably going to be okay.
Perfect, thanks. So Lou has the next question. Since it's always location, 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 where are you looking / developing? All right, I'll take this one, Lou. Ken, you can jump in later if you want.
Sure.
So you're right. It is location, location, location. Our company specifically, we're usually on the West Coast and Midwest. So take that into account, and we're all over. The key really,
You
with
mean the Western states, right, Mike?
yeah, yep, the Western states. But the key is there's pockets just about everywhere, and so it's important to not only look at a state or even a city, but you need to look at the neighborhood, because that's going to play a vital impact. I mean, we're currently developing, for example, this isn't multifamily, but we're developing a storage project in Mesa, Arizona right now. And in a lot of parts of Mesa, I probably wouldn't look to develop self-storage because there's a lot of them. But we're kind of on the outskirts in a really new, growing, developing area. And so, you know, in our market area, in our 3 to 5 mile radius, it makes all the sense in the world. So that's really the key. And that's why it's so hard to give you a certain city. You know, obviously we have certain areas where we're looking, but more important than a state or even a city is understanding really that neighborhood, because you can make a you can place a bad development in a good city, and you can place a good development in what most people would probably consider a bad city. You got any
Yeah.
more on that, Ken?
Well, uh, just the states that we look at, we're we're heavily invested in Utah, and that's because it's one of the number one business areas to do business by Forbes, and there's a lot of positives going on there with diversified economy. We love to go into areas that have diversified economies. Uh, Arizona is another big market for us. We love both of those. We love both of those markets. So
Yeah. And to embellish on that, I mean, we have stuff in Colorado, Wyoming, uh, South Dakota, Montana. We've done stuff in Texas, Oregon. So we're kind of all over the
yeah.
place. But yeah. Well, let's move on to the next one. So Curtis is he's asking, the economy is going great. Housing prices are high. I've heard the apartment prices are high. How can money be made buying apartments in the current market condition? Wait until it falls?
So if you want me to take this one, Mike,
Sure.
the economy is growing great and housing prices are high. Construction costs continue to rise. Rents continue to increase. And so it's a little bit like the stock market. When is the stock market too high? Well, usually when everybody concludes that it is too high and nobody's buying. But if you get in markets where the demand is good, you're going to see continued growth and in those markets. And when you say how can money be made buying apartments in the current market condition, we found from our perspective one of the best things we can do is to buy new, because we get a major price acceleration when we get the project stabilized. And so we like getting those bumps in appreciation when that happens. Uh, in terms of the cap rates for apartments, they are lower than some of the other property types. The cap rates that I'm seeing in apartments are ranging between 5 and 6%. In California, I've seen them go down as low as 2 or 3%, which to me doesn't
Yeah,
make a
it's
lot of
crazy.
sense. So, so you just have to look at good cap rates. If you can get anything in the neighborhood of 5, 6, 7%, you're probably going to get a deal that you can make sense out of. Uh, I I'm not of the opinion that you have to wait until the bottom falls out of the market before you can invest. We don't know when that is. Sometimes you can get a deal then, but usually your good projects, like Mike said earlier, the good ones do well in good times and do even better in bad times. So
Yeah, and just the last thing to kind of add to all of that, um, is, yeah, I mean, sometimes it does take a little longer when you're in a market like you are right now, but the deals are still out there. Um, I mean, sometimes you have to go through 10, 15, 20, 30, etc. properties to find the right one, but that's really where the last key in Ken's success steps comes in, is being persistent. So, okay, let's go to the next question. Uh, I won't put you on the spot, but this person said, I came in late to the webinar and unfortunately missed most of it. Are you able to send slides you went through? The answer is yes. So we will be, and Stephanie, please don't answer this one live because he put his email out there. So I don't know if they want their email out there. But the answer is yes. We will be sending this webinar out to everybody. I also recommend you go to overlandcapitalcorp.com. You can see this webinar. You can see all the past webinars. You can see investing articles. You can see projects. So definitely go there as well. Okay, next question. This is Curtis again. He's asking, when you're first starting, how can you get deals to compete for? How do you get brokers to take you seriously and send you listings and really advocate for you?
oh man, that is the $64,000 question when it comes to working with brokers. a lot of them don't want to work with you unless you come in with a lot of cash and you're a seasoned investor that they know is taking it seriously. The way I found is often you might have to work with maybe not the most seasoned broker, but somebody who has access to CoStar and all of the listings that come on uh, that you can have access through the national listing services like CoStar, and they can do a lot of research for you. I know in our uh, brokerage firm, we we pay a lot of money for CoStar, and that gives us access to every property that's available for sale in every market in the United States. And and then we have agents that are anxious to work with new clients and help work that process through so that they can get a good investment. I don't think a lot of the big firms will do that with you, but you can sometimes find a good smaller firm that'll do that with you.
Yeah, and just the more active you are in the space, even if you're not
Um,
buying apartment after apartment, the more active you are in the space, you'll start to find those relationships, those people who will go to bat for you. Um, and like Ken said, they might not be the largest, but you can find them. The important thing is to be active,
but
actively looking, actively talking.
but you do have to be serious about it. If you spend all your time looking and after brokers brought you half a dozen deals and uh, and you can't pull the trigger on something, then uh, then they're going to quit working with you. They're going to get a little frustrated by that.
Yeah,
So
yeah, there's definitely a balance there. Okay, next question. So, Ryan, it looks like we answered Ryan's question a little bit, but I think there's some room to embellish on here. So, Ryan said, where do you look to find deals? Do you go to brokers, business brokers, investor networks?
usually, not so much business brokers, investor networks. I've seen a lot of investor networks that are trying to do small deals, single family homes, duplexes, triplexes, fourplexes, things like that. So if you're just starting out, you might want to go to a real estate investment association. There are some located in every state and most major cities. That's where you can begin to rub shoulders with people that are doing this kind of thing. Uh, when you really want to drill down and look for a property that you want to purchase, if you're looking at smaller deals, the local multiple listing services that are working within the state, like we're in the Salt Lake Valley, so it's the Salt Lake Board of Realtors, they will actually list the smaller real estate deals, uh, smaller apartment deals. The bigger ones, CoStar is the name of the game. Uh, Unfortunately, they basically have a monopoly on the market. They used to have some competition, uh, but they either bought out their competition and or they bought out LoopNet, for instance. So they either bought out their competition or forced them out of business. So CoStar is the place to go if you really want to drill down on good information, and most commercial brokers have access to that.
Perfect. So one thing I just kind of want to mention as we're going through all these, I'm finding a theme, right? It feels like we have a lot of new investors on here, and that's perfect. So one of the things that I definitely would recommend if you're a new investor is to maybe look, this is different than probably what you're thinking, but maybe look at a syndication, right? I mean, if you look at a syndicated deal, you're going to be surrounded by experience. You're going to have to invest less money, but you're going to get to see and understand a lot more about how the whole process works. You're going to get updates. You're going to see financials. You're going to see the rent up and the leasing and what things are going on. So, I mean, it lets you dip your toe in there without having to take the risk of putting down, $5 million to go buy your own property. So you can absolutely go buy your own property, right? And that's totally good, and happy to do that. Make sure you surround yourself with good people. But I would definitely at least consider that. Um, okay, next question. Connie, do you have any deals you are allowing others to invest in coming up? So I'll just quickly answer this, Connie. We actually are fully committed on everything that all of our current projects. We're taking some wait list people, but we do have more coming up. We always have more coming up. So best thing to do if you want to know about deals coming up is go to overlandcapitalcorp.com and go to investing tab and click on the investor application. That'll let you fill out the application and get into our investor network, and that's what keeps you updated on the deals and have a preferred access to all of our deals coming up.
Yeah, we've got three that we're seriously negotiating right now, but
Yeah.
we just completed basically a $15 million raise on a $53 million 240 unit apartment project in Mesa, Arizona that we're doing. So
Perfect. So it looks like that is all of the questions that we've got. Yeah, we really appreciate everyone attending the webinar. We're excited for you. Multifamily investing is one of the best ways, in my personal opinion, to get to the next level. The power of multifamily is just, I mean, it's really, there's nothing quite like it. I mean, wouldn't you agree, Ken?
yes, I think it should be one of your core investments. And uh, I hate to get on my soapbox, so I'll try not to do that. But most financial planners say don't invest more than 15% of your money in real estate. And I think that's absolutely crazy. I think you should have at least 50% of your investment capital in real estate because that needs to be the core foundation base of your entire portfolio. If you have that, then when you're ready to retire, that's the time when that passive income kicks in. And unless you've got a good base of real estate assets that continue to appreciate in value, continue to grow in cash flow, uh, uh, you're just at the whim of the stock market, which is not where you want to be, I don't think.
Okay, and with that, we'll go ahead and end. We appreciate everyone coming. Make sure you have a great rest of your day, and feel free to reach out if you have any questions. Our email and website information are all there. So appreciate it, and have a great day.